Hello everyone. This week we will learn a little about the conceptual framework, which is considered as an important topic, especially for your CPA prep course. You probably learned a little in your intermediate accounting course, but sometimes it feels a little bit abstract to grasp all these qualitative characteristics and especially all those principles and concepts, because we all love to deal with the numbers, solve problems, but we really need to focus on this qualitative part. So here first we will learn about the accounting standard setting bodies. So we all know that in United States the Securities and Exchange Commission plays the vital role to set the accounting standards, and that is the legal authority. So here basically this SEC actually assign the authority to the other body, which we know this is called FASB, or Financial Accounting Standard Board. This FASB is an independent full-time organization, and they actually determines the accounting standards or GAAP. But FASB was established in 1973. Before that, there were two other part-time committees of the American Institute of Certified Public Accountants, that means AICPA. They actually determine the standards. So these two part-time committees are, one, we call it CAP. So CAP stands for Committee on Accounting Procedure. Committee on Accounting Procedure, and they actually determine this GAAP since 1939 to 1959. So just to know a little about the history, they actually determined GAAP from 1939 to 1959. Then AICPA appointed another part-time committee, which was known as APB. So this APB stands for Accounting Principles Board. APB, Accounting Principles Board. And they actually determined all those accounting standards from 1959 to 1973, before the FASB was established. And since 1973 to until now, FASB actually prepares the accounting standards. But remember, SEC actually has the ultimate authority. So I'll also write down here FASB, and we all know it, we all should know it, Financial Accounting Standard Board. And they are preparing all these accounting standards from 1973 to now. Now, here you will also learn about the codification. So, effective in July 2009, the FASB became the only single source of authoritative non-governmental US GAAP, and they established the codification. So, this codification basically known as ASC. What does it mean? ASC, just try to be familiar with these terms. ASC means Accounting Standards Codification. Accounting Standards Codification. So now here we will focus on the conceptual framework, and we'll focus on only a couple of important items here. One of the important item, it is known as SFAC number 8. So this is again SFAC. This is Standard Financial Accounting Codification, and here we will know In SAFC number 8, we will know first the objective of financial reporting, and then you will also learn about here the qualitative characteristics of financial reporting. These are all qualitative characteristics. Now here we all are more or less familiar about the objective of financial reporting, right? So the objective of general purpose financial reporting is to provide the financial information about the reporting entity, that means about the company, which is useful to the primary users. So who are the primary users? Of course, existing or potential investors, lenders, creditors, any other party related to the company, regulators. So the main objective is to provide the financial information to the primary users. Now here, if we focus on the qualitative characteristics of financial reporting, then these qualitative characteristics are really very important and useful to all those primary users, because these qualitative characteristics actually ensures how important or how reliable the financial information is. So here you will see for the qualitative characteristics, we basically can categorize it into two groups. One is related to the relevance of the financial information, we'll discuss in a minute. Another is the faithful representation of the financial information. So now what do you mean by relevance? So financial information is relevant if it is capable of making a difference in the decisions made by the primary users. That means if you find any information which can affect the decision of an investors, of course you can call it the information is relevant. Now, to judge or to assume that this information is relevant, you need to think of three qualities. One is the predictive value of that information. Second is the confirmatory value of the information. And third is the materiality. So what do you mean by predictive value? The information has a predictive value if it can be used by the users to predict any future outcomes, right? For example, the company has decided to go acquire another company, and this information is really very relevant for any users because the acquisition may determine what could be the future outcome of the company. That means this information is relevant and it has a predictive value. Now, confirmatory value. So information has confirmatory value if it provides feedback about evaluations previously made by users. And last but not least is the materiality. And information is material if an omission or misstatement of the information could affect the decisions made by the users. But the materiality, of course, can vary depending on the size of the company or the information, what type of information you are providing to the users. Now, this is all about relevance. So if you want to consider one information relevant, of course, it should affect the investor's decision and it should have the predictive value, confirmatory value, and materiality. Now, if you focus on the faithful representation part, of course, faithful, the term itself means that the information must be reliable and must be useful, and to judge the faithfulness of this information you have to consider few other aspects. That means the information must be complete, the information should be neutral, and last but not least, the information should be free from error. So we can call a piece of information it is faithful if you can ensure that the information is complete, the information is not biased, or the information has no intentional errors. So now, how we can enhance these qualitative characteristics? We are now focusing on SFSC number 8, and of course one important aspect is the qualitative characteristics, and we categorize the qualitative characteristics into two groups, relevance and faithful information. Under each group you should consider some other criteria. Now, to enhance the qualitative characteristics, we also need to ensure some other aspects, which are, I'm talking about enhancing these qualitative characteristics. And to enhance it, we can consider three other criteria. Number one is comparability. Actually four criteria: comparability, we can say one information is really very useful, or the qualitative characteristics are really well if we can easily compare that information with other similar type of information. So comparability is really important. Another is verifiability. When we are presenting in information to the primary users, of course the information should be reliable, neutral, free from error, but at the same time we need to make sure that the information is verifiable and the information is also timely. That means timeliness of information is also important, and it enhances the qualitative characteristics of financial reporting. And that's why you will see that for many cases, actually the SEC fixed the dates that within 15 days or within 90 days you have to report these information. So timeliness is really very important. And another item that can also enhance the qualitative characteristics, which is understandability. And information could be really relevant and it could be free from error, but if you present it in a complex way and if it is not easily understandable, then there might be some questions about the qualitative criteria of that information. So companies also need to work on that understandability to enhance the qualitative characteristics. Now here we will focus on another SFAC, or another part of this codification. It is number 4, and it actually discusses about the financial reporting by non-business organization. And I don't want to focus on it because next part of our course will focus on these organizations. These are non-business organization. So far you learned about the business entities where most important goal of these type of organizations are profit making, but now here you will learn a little about the non-business organizations, and these statements actually describes how a non-business organization can be different than a business organization, what are the main criteria, what should be the characteristics. So of course a non-business organization, the main motive is not to make profit. Of course, they need to raise their funds, and basically they raise their funds from different type of contributions and grants. They can provide some goods and service, but the intention is not for profit. And there might be some owners, but these ownership interest cannot be sold or transferred, or even in case of liquidation, the owners cannot expect to receive any benefits or any resource. So here actually our financial standards also describes what should be the criteria, what should be the objectives of this type of non-business or non-profit organizations. So who are these type of organizations? It could be any charity organizations, NGOs, foundations, non-profit universities, hospitals. Although they are not making any profit, still you need to provide the information to the external users. You need to ensure that the information is reliable and the information is comparable, because those type of information will help the users to know how they are allocating their resources, what type of service they are providing, and it also makes sure that the owners or the managers are doing their job correctly. So basically here in later chapters we will focus on these non-business or non-profit organizations. Now next part we will focus on SFACs, another statement number 4, and that focuses on recognition and measurement in the financial statements. So recognition, this term is really important. So what do you mean by recognition? Recognition means to record the event, record the economic event. So recording or recognition means basically, if you think of the first step of your accounting cycle, you are doing a journal entry, and that recording will have an impact on your financial statements. So we all are familiar with the financial statements, all those financial statements, balance sheet or income statement, statement of retained earnings. Sometimes if it's a big company or they have multiple subsidiaries, you may need to, or multiple segments, you may need to prepare a statement of comprehensive income. And then you also need to prepare cash flow, statement of cash flows, right? So when we recognize or record any event, that will have potential impact on these on these different parts of a financial statement. Of course, you may not record each and every event, but you have to be very careful. The events that meet the criteria of recognition, you need to record it. But sometimes we may not record some events, but of course there is another option in your financial statements. It's called footnote. So there is a huge debate, and especially the FASB and IASB, they are working together on different issues, whether those items should be recognized. That means those will be recorded and will have impact on your different parts of financial statements, or if you need to include those in your footnotes. So now you need to know about the fundamental recognition criteria. So what are the criteria? So there are 4 criteria. So if you want to record any event, so first you have to classify the event. You have to define the event. So this is called definition. That means you have to define the event, classify the event, and every event should have different type of items, and we actually classify into different account categories, and you should be familiar with those categories such as assets, liabilities, revenues, expenses, right? So these definition element or criteria means that this is it meets the definition of an element of financial statements, and you can classify it, and you can consider it in one of these 4 categories. Now measurability means that the item or the event should be measurable, and of course we usually try to measure it in terms of monetary value, right? So second criteria for recognition is measurability. For example, you can find some events such as one of your very skilled, reliable managers actually passed away, which is really a great loss for your company. But this type of loss is not measurable, so you cannot record it. Now another criteria, which is relevance, and this relevance is of course related to the basic qualitative characteristics of your overall financial statements. That means relevance, and this is the same idea that if you find any information, any event that can make a difference to any investors or any financial statement users decisions, then you have to record it. Now last criteria is reliability. That means the information, whatever you want to record, you have to make sure that it is faithful, it is neutral, it is free of errors. So recognition is really important, and you have to be careful whether what should be recorded or recognized and what you need to put as a footnote. And these are the criteria when you are going to recognize any event or any item. Now we will focus on some fundamental assumptions and principles. You probably have learned a little bit, but I will again focus on it. Some basic fundamental assumptions. One is the entity assumptions. So the idea of these entity assumptions is that a corporation is considered as a separate entity, and there is a separation between the ownership and the corporations. Another assumption is called going concern assumptions. So these going concern assumptions is that we assume the business entity will continue to operate in the foreseeable future. But you just finished the other chapter, which is bankruptcy and liquidation, and that may not happen every time. That means it is also possible that companies need to be liquidated or stop doing their business when the company is bankrupt. Now another assumption, fundamental assumption, is monetary unit assumptions. That means we need to express or record anything in terms of some monetary unit. So this monetary unit is basically the basis of our economic activities as well as our financial statements. So our third assumption is monetary unit assumptions. And then you will also see a few other assumptions. One is periodicity assumptions. Periodicity assumptions means that all economic activities can be divided into some meaningful time periods, and we usually produce our financial statements for a fiscal year. This is one meaningful period. Sometimes we can also split to meet the regulatory criteria, for example, quarterly reports. Another assumption, basic assumption, is measurement assumptions, and this assumption actually discusses about the measurement of assets and liabilities. So this is called the measurement principles. And we know there are several ways you can measure an asset or a liability. For example, historical cost approach, that's what we follow for long-term or fixed asset. Or you can also follow the LCM method for inventory, that means cost or market. We can also follow for some specific assets to report them as per the net realizable values. So these are another assumptions and principles. I want to focus on one important part, which is we all are familiar, which is accrual accounting. So we of course follow accrual basis accounting. It's not cash basis accounting. And here under these accrual basis accounting, cash receipts and cash payments doesn't matter. What is matter is recording the events, and of course we need to talk about two items. One is revenue recording or revenue recognition, another is expense recognition. So under this accrual basis accounting, there are two principles we all are familiar with. One is called revenue recognition principle, and another is expense recognition principle. So revenue recognition principle states that you need to record the revenue when you earn the revenue. It doesn't matter whether you receive cash or not. So that means when you provide any service, when you ship any goods, you earn the revenue and you record it. On the other hand, expense recognition principle says that expenses are recognized in the same period as the related revenues, and of course when the expenses are incurred, cash payment doesn't matter. That means these two should be matched, revenues and expenses, and of course cash payment, cash receipt is not a big deal here. It is not at all important. In that sense, we follow the accrual basis, not the cash basis. So what is the most important idea here is that record the revenue when you earn it, record the expense when you incur it, and of course the expenses should be matched with the revenue during the period when you are recording it. And another is full disclosure principles, and this principle actually states that the users must be given the full set of information, and of course this information can make a difference in investors or any type of users decision, and that is called the full disclosure principles. So here in this chapter later you will learn about the basic elements of the financial statements and of course all those items. So I already posted the prep materials and you will have a little portion on your exam 1 from here. So I would suggest please read the content or the reading items that I provided here, and I also made a sample quiz. It's non-graded, but you can just take the quiz. And I also uploaded this statement of financial accounting concepts, SFAC concept number 8. That means especially the purpose of the financial reporting and the qualitative characteristics of the financial reporting, and that's the original document from FASB's website. So it's a quite bit long, but as an additional reading, if you could take a quick look, that would be really very useful for this course, for your learning, and of course those who are preparing yourselves for the CPA exam.